Before leaving on his trip to China, U.S. Treasury Secretary Henry Paulson told a Washington gathering Beijing must help lift the global economy out of its slump by taking more steps that would shrink its massive trade surplus.
Now is an opportunity for China to take measures to ensure sustainable, strong, and balanced economic growth for its future. This means relying more on domestic demand and less on exports to drive growth.
Doing so, Paulson added, would involve reforming China's currency policy. He praised China for letting the yuan rise more than 20% against the dollar in the last 3 years, but the currency fell sharply for the second straight day. Many U.S. exporters have charged that the currency is undervalued. A weak yuan makes Chinese goods cheaper for Americans to buy, but makes U.S. exports pricier.
As I have emphasized in the past, continued reform of China's exchange rate policies is an integral part of this broader reform process.
President-elect Barack Obama has maintained in the past that China is manipulating the yuan to keep it weak, a charge Paulson has refrained from making. The director of the Peterson Institute for International Economics, Fred Bergsten, says that Obama will crack down on the currency issue as president.
Well, I think President-elect Obama has been correct to criticize China's currency policies. They have deliberately kept their exchange rate way undervalued, sharply improving their competitive position through massive intervention in the currency markets. Secretary Paulson and the Bush administration have made that same criticism, but they have never been willing to carry out U.S. law and label China as a currency manipulator, as our law calls for. I'm quite sure President Obama will do that.
Paulson called Obama's election victory a strong mandate, one that will help him deal with the financial crisis. In what will be the last of his twice-yearly meetings with Beijing officials, Paulson will also try to tackle product safety, investment, energy, and the environment. Fred Katayama, Reuters, New York.